So the next non-sexy secret that we are going to talk about is tax. In the first case, I just started here for all my case studies, I assume my son, he's just 19 years old. In fact, right now he is doing his national service. So I assume that, someone like him starts with a portfolio of $10,000. And I've shown a 50-year track record. And all my case studies, I show 50 years simply to use an entire investing lifetime to show you what happens over a lifetime. Most of us, we often get very bogged down by the short term. We buy a stock, the stock runs up, becomes a 3-bagger, 4-bagger. We feel very happy. But the end result of an entire investing lifetime, it is much more than just, one stock running up. As our subscribers would know, that our principle is to find ways to maximize the return on our capital, to maximize the capital on which we are achieving that return. So we are talking of our entire capital that's available to us, and to maximize the time frame over which that high return on capital is achieved. So if I can maximize these 3 factors, then my long-term result will be phenomenal. And Buffett is a great example of that. So here I have taken a 20% return. Now, before you jump saying that, oh, that's too difficult to get, you can choose your number. It just doesn't matter. If you feel comfortable with 4%, take 4%, 8%, the math stays the same. So here I have assumed in the first scenario, he starts with $10,000 and he's a short-term investor. So every year he's selling his investment, achieving a 20% return. And because there is a tax of 15% on his gains, so every year he's paying out a 15% tax on the gains and getting to reinvest the rest. So like this, at the end of his 5-decade period, he has a huge amount of $25.6 million. Now, in the second scenario, everything is exactly the same 20% return, 15% tax rate. But the only difference is, in the second scenario, he does not sell his investment. So he keeps sitting on unrealized gains, which means the tax is just accrued. It's not paid out. And he gets to compound the entire amount. And then at the end of 50 years, on the 51st year, he has $91 million. That is the time, let's say he decides to sell his investments, and he has to pay his accrued tax, right? So he pays a tax of $13.6 million. And you can see, even though I told you that we shouldn't add money across time, but here the amount of tax that he pays on a purely cumulative basis is higher than the tax that he pays in the first scenario. But look at his end result, $77.3 million, which is 3x of what he would have in the first scenario, simply because he transacted less and he just deferred his tax payout. So this is the wisdom of deferring your tax payout. So now for all those who are from Singapore, so think in something like SRS, isn't the same thing happening? So it's a combination of the two concepts. One is by investing the 15,300 in SRS, you are saving on some tax payout. Now, the tax eventually will need to be paid when you finally end up selling, but then that selling can happen decades from after you retire. And that too, there are ways of taking that money out. And only after that, you pay tax on half of that. So you significantly defer your tax payout. Plus, you apply the same concept. The amount which you save by not paying out to the government, you invest on your own. Exactly the same scenario that I showed in the term life versus whole life comparison. And you can imagine, you can do the calculation yourself and see the benefits. So you see, isn't this an eye-opener? 25 million when he's transacting every year versus 3x of that, 77 million, just by deferring his tax. So if you think this is an eye-opener, type EO, stands for eye-opener. Understood this concept of what happens when you can defer your tax. It was a major aha moment, major eye-opener for me. And again, the long-term results is a sum total of all these knowledge put into practice.
If you found this video interesting, then you should definitely join our research platform. It's completely free to join. There are no hidden costs. And that's where we publish our free research on several high-quality businesses, which are typically compounders. The link to join is available in the description section below. And I also welcome you to join our Facebook group called the Investment Forum. That's a place where we discuss these high-quality businesses with several other DIY serious investors. And you will benefit from the discussion, I'm pretty sure. And if you enjoyed this video, can I please request you to hit the like button and do subscribe to our channel. It does not cost you a penny, but it'll really help us with the YouTube algorithm. And we will be able to notify you whenever we are coming up with other interesting videos on company research or other investment concepts. So I'll see you in the next video. Thank you very much for your time.